$34 trillion. That is the current debt of the United States government. For many people, this number seems like just another distant statistic. But when we try to understand the real size of that amount, the scale becomes almost absurd. If someone spent $1 million per day, every day, without stopping, it would take almost 100,000 years to spend $34 trillion. That number is larger than the size of the economy of many countries. In fact, it is larger than the annual GDP of most economies on the planet. But what really draws attention is not just the size of the debt, it is the fact that it continues to grow every single day. While you watch this video, the United States debt continues increasing. Millions of dollars every minute. Billions of dollars every week. Trillions accumulated over the years. This happens because the American government spends more money than it collects. When a government spends more than it receives, it needs to find a way to pay that difference. And that is exactly where public debt is born. The government borrows money. To obtain that money, it issues bonds. These bonds are called United States Treasury bonds. In practice, they function like a large collective loan. Investors buy these bonds today, and the government promises to return the money in the future with interest. This system has existed for decades, and for a long time. It worked without major concerns. That is because the United States possesses something that few countries have: a gigantic economy, an enormous financial power, large global companies, top universities, and an enormous political and military weight on the international stage. But there is an even more important factor: the dollar. The dollar became the main currency of the planet. A large part of international trade happens in dollars. Oil is traded in dollars. Technology is traded in dollars. Energy is traded in dollars. Raw materials are traded in dollars. This means that countries around the world need to maintain reserves in dollars. These reserves function as a kind of financial insurance, and when countries hold large quantities of dollars, they need to invest that money somewhere safe. For decades, the place considered the safest in the world was American debt. Because of that, foreign governments buy treasury bonds. Central banks buy treasury bonds. Huge funds buy treasury bonds. Institutional investors buy treasury bonds. This constant flow of investors allowed something extraordinary. The United States managed to finance its debt for decades without facing major crises of confidence. But this also created a consequence. The debt kept growing decade after decade. For a long time, this growth seemed controlled. In the 1980s, American debt was less than $1 trillion. At that time, that number already seemed enormous. But in the following decades, several factors began to accelerate the growth of the debt. Tax cuts, increase in public spending, economic crises wars, social programs, financial stimulus plans. Each of these decisions increased the government's need for financing. And whenever the government needs to finance new spending, it issues more debt. Over the years, the number kept rising. 1 trillion, 5 trillion, 10 trillion, 20 trillion, and now more than $34 trillion. Never in modern history has an economy accumulated a public debt this large. This raises a question that is beginning to concern analysts. How long can this model continue to function? Because even if the American economy is extremely powerful, no financial system grows infinitely without raising questions. And that is precisely why economists began analyzing something very important. Who is actually financing all this debt? Because understanding who buys this debt is fundamental to understanding how this entire system works. And that is exactly what we are going to explore next. When we talk about a debt of more than $34 trillion, an inevitable question arises. Who is lending all this money to the United States? The answer may surprise many people because it is not only the American government that sustains this system. In fact, A large part of the American debt is financed by investors spread all over the world. Part of these investors are inside the United States itself. Pension funds, investment funds, insurance companies, banks. These institutions need to invest trillions of dollars every year. And one of the safest options historically has always been the debt of the American government. But the story does not stop there. A huge portion of the American debt belongs to foreign governments. Countries that buy United States Treasury bonds. Among the largest creditors are Japan, China, United Kingdom, and several central banks around the planet. This happens for a simple reason. International reserves. Countries accumulate reserves in strong currencies to protect their economies. These reserves function as a financial shield in moments of crisis. And the most used currency in these reserves is precisely the dollar. When a country holds billions or even trillions of dollars saved, it needs to invest that money. And for decades, the investment considered the safest was buying American debt. This created a curious dynamic in the global economy. While the United States issues debt, the rest of the world buys that debt. In practice, this means that global investors help finance the American government. But there is an important detail in this system. Every debt has a cost. That cost is called interest. When the government borrows money, it promises to return that money in the future with a reward for the one who lent it. That reward is the interest. And the larger the debt, the larger the interest payments tend to be. For many years, this cost was relatively controlled because global interest rates were very low. But in recent years, something began to change. Global inflation increased. Central banks began raising interest rates, and this made the cost of debt rise. Today, the United States government pays hundreds of billions of dollars per year only in interest. Money that does not build roads, does not finance hospitals, does not invest in technology. That money only serves to pay the cost of money borrowed in the past. Some analysts believe that in the coming years, interest payments may become one of the largest expenses of the American government, larger than many social programs, larger than infrastructure investments, and possibly comparable to parts of the military budget. This creates a curious effect. The larger the debt, the larger the interest payments need to be. And the larger the interest, the larger the debt tends to grow. It is a cycle that depends on a single thing to continue functioning: confidence. Investors continue buying American government bonds because they believe that the United States will always pay its debts. As long as this confidence exists, the system continues functioning. But this confidence does not appear from nothing. It is sustained by something extremely powerful: the dollar, the currency that dominates a large part of the global economy. And it is exactly this factor that helps explain why the United States can maintain such a gigantic debt. But this also raises an important question. What would happen if one day the power of the dollar began to change? Because if that happens, the entire balance of the global financial system could be affected. And that is exactly what we are going to explore in the next part. There is a word that supports a large part of the global economy: confidence. It sounds abstract, but in the financial markets, confidence is worth trillions. Investors buy American government bonds for a simple reason: they believe the United States will always pay. That belief sustains the system. It makes banks buy American debt. It makes funds buy American debt. It makes foreign governments buy American debt. It makes the entire world treat United States Treasury bonds as a safe haven. But there is a problem. This system depends on confidence continuing to exist. And the question that is starting to emerge is simple: what happens if that confidence begins to weaken? If investors begin to think the risk has increased, they will demand something in return: higher interest rates. And this is the first major danger. If interest rates rise, the cost of debt rises with them. That means the American government needs to spend even more money just to continue financing its own debt. And that creates a dangerous cycle. More debt, more interest, more pressure, more need to issue new debt. The larger this cycle becomes, the harder it can become to control. And there is a second risk. If some investors begin looking for alternatives, demand for American bonds may weaken. That does not necessarily mean an immediate collapse, but it does mean something important. The government may have to offer better conditions to continue attracting financing. In practice, that means paying more to continue borrowing. And when we talk about the United States, even small changes can have enormous impact, because we are talking about the largest economy on the planet, an economy that influences global interest rates, global markets, global currencies, global trade. If the cost of American debt rises too much, the effects can spread across the entire world. Companies feel it, banks feel it, markets feel it, emerging countries feel it. Investors begin recalculating risks. Stock markets can fall, currencies can fluctuate, credit can become more expensive, and money begins circulating with more fear. But there is something even more important. The United States is not a normal country. They have an advantage that no other economy possesses at the same scale. The dollar is not just the currency of the United States. It is the central currency of the international financial system. A large portion of the world's reserves are in dollars. A large portion of global trade happens in dollars. A large portion of energy transactions happens in dollars. This gives the United States enormous power. It is precisely this power that allows the country to carry a gigantic debt without facing the kind of crisis that other countries would face. If a smaller economy accumulated debt at this level, it could collapse quickly. But the United States operates on another scale, with another level of influence, with another level of political weight, with another level of financial power. But even this advantage does not eliminate all doubts, because even the strongest system in the world can begin to show signs of strain. And in recent years, some movements have started to draw attention. Countries discussing trade in other currencies, economic blocs seeking alternatives, central banks reducing part of their exposure. It is not a total change. It is not an immediate rupture, but it is a signal that the world is watching. And when the world starts watching a problem too closely, it is because that problem no longer seems impossible. That is why the American debt of $34 trillion attracts so much attention. Not because the United States is about to collapse tomorrow, but because gigantic numbers always carry gigantic risks, and because very large systems, when pressured, do not affect only one country. They affect the entire planet. In the end, the big question is not just whether the United States can continue carrying this debt. The real question is another. How long will the world continue accepting this game in the same way? Because as long as confidence exists, the system continues functioning. As long as there is demand for the dollar, the system continues functioning. As long as investors believe the United States remains the safest center on the planet, the system continues functioning. But if any of these pillars begin to weaken, the impact could be enormous, not only in Washington, not only on Wall Street, but across the entire world. And that is why this debt is not just a number. It is a warning about the size of American power.